On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects. Oh, welcome to the On the Tape podcast. Guy Adami, Dan Nathan, Danny Moses. Danny, how are you?
I'm great. Great to be.
You
Spring
look
in
great.
New York.
You're back.
Spring in New York. Big East tournament. The train I had to fight the UConn fans on my way in.
Did you have that altercation?
No, not an altercation. I mean, fight for room.
I understand.
Yeah.
For seats.
Seats.
People get a little tuned up early.
They were
for
tuned
these-
up.
Yes.
I go, why is your game at noon?
It makes no sense.
Okay, anyway.
Dan Nathan, how are you?
I'm doing great.
Does anybody care what I did earlier this week?
Depends what you did, actually.
I mean, I'm looking for.
And we can always
I
cut
need
it if
people
we
to
don't
sort of
care.
like.
Yeah.
So on Wednesday evening,
Yeah.
my wife Linda Snow and I,
Yeah.
along with my friend John Hyland and his
Linda
wife
Snow.
Kristen, Linda Snow, we went to see Peter Frampton at the Morristown Performing Arts Center. That Peter Frampton.
Do you?
Peter Frampton of Humble Pie, Peter Frampton.
Yeah.
You know this.
So I know
Peter
that you
Frampton,
went
by the
there.
way,
I
he
know
just
where- I know
found
where-
out
And he was in the
Yeah.
late 60s.
that he's
I know it all.
that he is being nominated to be in the Rock and Roll Hall of Fame.
How is he not in it already?
Exactly.
It's crazy.
And that's the point that I made. It's disgraceful that he's not in already.
So Frampton's coming alive, is that
Well,
what you're saying?
I like what you did there.
Yeah.
But that album came out in 1976, that live album. To this day, one of the greatest selling live albums of all time. Do you feel like I do? But one of the great songs on that album is Show Me the Way. I want you to show me the way. Now, in many ways, Danny Moses, you've been trying to show people the way in the form of some of these trades. I know you have as well, Dan Nathan. I am here to tell you folks on the On the Tape podcast that there's something showing us the way. By the way, Dan and I will talk to Caleb Silver, the editor-in-chief and host of Investopedia's Express with Caleb Silver.
I have a thing to say about the Hall
Go,
of Fame.
say it.
So we never got to talk about Apollo Creed, Carl Weathers.
No,
Rest
we
in
did
peace.
not.
Okay,
Rest
hold
in
on.
peace.
But I have a big problem. Sylvester Stallone's in the Boxing Hall of Fame.
As he should be.
Okay. He's a fictional character in the Boxing Hall of Fame.
Yeah.
Why isn't Apollo Creed or Carl Weathers in the Boxing Hall of Fame? And why isn't Roy Scheider in the Fishing Hall of Fame?
Well, no. Forget
What?
Roy Scheider.
Why?
Robert Shaw should be in the Fishing
Fine.
Hall
Anyway,
of Fame for his
so this
portrayal
Hall of Fame
Quince.
stuff, if you're going to do stuff, do it right. And I have something else.
Well, let me hear it.
March of 1984.
March of 1984, I was a sophomore in college, I believe.
There was a great movie that came out. This is Spinal Tap, which
Oh, my God.
amazing, right?
This goes to 11.
Put it on 11.
This is going to be an abomination, though. They're doing a follow-up. They're doing a sequel.
Did not know that?
Oh, yeah. It's coming out.
so
Rob Reiner's doing it. And by the way, March of 1984, what happened, Guy?
Well, the Georgetown Hoyas,
There
I
you
believe,
go.
emerged victorious in the national
Correct.
championship game against, I believe it was the Cougars of Houston.
Yeah.
The Guy Lewis-led Cougars of Houston. You know this.
Yeah. And
By the way, Michael Graham was on that team.
Can I go back to my
Moonlight
thing?
Graham.
Yeah, go.
Moonlight
Not
Graham.
Moonlight
Can I
Graham.
go back to Archibald Moonlight Graham? Put it on 11. Okay.
Yes.
Couple things.
This goes to 11.
Right. This market's been on 11.
I agree with that.
1 to 10, go to 11. It can go there.
Yeah.
Put on 11. Put on 11. You know what else is 11?
Tell me.
Tesla is now the 11th largest company in the S&P 500, which we can talk about.
Did
but
you
anyway.
listen to our conversation with Melissa Lee last week? CNBC's Fast Money.
Yeah,
with
I did.
Melissa Lee. Okay, so it's interesting. One of the things that I found pretty fascinating is like we took a lot of heat about Tesla last year. We took a lot of heat. No, and because in the end of 2022, you remember it fell off like the face of the earth. It went from like 200 to 100 in a straight line.
108, I think. but
in
yes.
like a month. And so, it's funny to us that confirmed just, basically a bloodletting. The bulls just kind of had enough. They said, uncle, you know what I mean? That sort of thing. And then it spent the balance of 2023 kind of rallying to a point. But if you just look at what's gone on, and we've talked about this, the last 4 quarters that the company's reported is gapped down 10%.
Yeah.
So every time they reported a quarter and guided, the stock went down 10%. It made a series of lower highs, and here we are. We're back very near 52-week lows. So as we're recording this Thursday into the close, the stock's down 4%, trading at 162. The April 2023 low was 152. And so I guess my only point, Danny, we were talking about this, is like, okay, you can be wrong on price and right on fundamentals in some of these markets.
For a long time.
Right? So like, talk to us a little bit about that, because I think collectively we were talking about China. We were talking about competition. We were talking about the Musk factor. We were talking about how Tesla was basically the bank account for its, his Twitter acquisition and all this sort of stuff. So put it all together. A year later, This thing has massively underperformed
Well,
the S&P 500 and the NASDAQ.
It has clearly become an auto company more than anything. I think
Yeah.
people are giving up the ghost as far as, tech and this stuff. So here you have it. It's still a $500 billion company.
Yeah.
So forget about where the stock has come from. Forget about where it went and what it's come back to. On an absolute basis, is it worth $163? No. Can it bounce because it sold off so much? Sure, technically speaking. But the fact that we're here, it sells a long way to go. And what we talked about last year was you can own a GM or a Ford and a Microsoft, and you can get the best of both worlds potentially. An auto company with a solid balance sheet, and then a growth company that has a piece of AI in it. Instead of waiting for this, and earnings continue to come in on the name, right? And now it gets more expensive. Actually, yeah, the stock's down. It gets more expensive, I think, by the day because of the earnings cuts, which are coming.
Well, and consensus for deliveries, Guy, for Q1 are still way high. A bunch of analysts have gone down to 420,000. I think the consensus is still up at 470. But guys, speak to that because you didn't get involved in that bit of the conversation with Mel last week. Is the idea that you can be right on fundamentals, wrong on price, and then we have people as pundits, Danny, like you as just an investor who gets the mic in front of you once a week.
Yeah.
You can have a couple tidbits here. We kind of have to update this on a daily basis or whatever. Like the idea that we can't just be kind of flying, like back and forth, changing our tune all the time, but you can like be told, oh, you got to trade the market you have. Sometimes the market you have is fucking stupid.
Well, that's fair. Listen, what it comes down to, and the point you've made correctly, is when fundamentals have mattered in Tesla, the stock has gone lower. I mean, that's really as simple as that.
Mm-hmm.
And now it's not about, now the stock is going lower in the absence of fundamentals. Now, there's some fundamentals out there, but now I think the market is starting to catch on, and that trough margins that we thought happened 2 or 3 quarters ago, turns out it wasn't trough margins. And now people are coming to the realization, as Danny said, that maybe out of all of this, it should be valued more like a legacy auto company. Not the same valuation as GM as Ford, but it should come down a lot more, and maybe GM and Ford should be rewarded. And I think that was a trade that you talked about, and that's working. So the levels you mentioned are the levels. That 152 level sticks out. We've talked about it for a while. And the fact that Tesla is now down probably 60% from its all-time high on a broader market that's effectively at its all-time high tells you all you need to know. You can call us haters, call whatever you want. The reality is this stock has been a dog for the last 3.5 or so years, and that's just my quick take on that. One of the things that's showing me the way, and it's always comes down to me, bonds and currencies. And the bond move has been extraordinary. We had PPI on Thursday. We had CPI earlier this week. CPI was hot. Market didn't seem to care. As a matter of fact, the market seemed to reward investors for that. Obviously, PPI came in twice as hot as the market was anticipating. 10-year yields, which I think troughed around 4.07%, are now either side of 4.3%. Now, people say, you know what, it's noise, it's not a big deal. Danny, I think it is a big deal. I still think inflation is a problem. I'm one of the few people that think that, but it's starting to reaccelerate, and I think that makes the Fed's job, which everybody seems to think is so easy now, that much more difficult.
Yeah, so this is like the last big inflation print before the Fed meets next week. I think the CPI kind of brought it back to light again that, hey, maybe higher for longer. PPI may have solidified that, and now you're seeing a readjustment. And let's not forget, there's tons of auctions coming. There's a lot of debt coming from the U.S. Treasury, right, that needs to get sold out into the marketplace. And so, it's amazing how quickly you turn. You start dropping from 425 to 408. We're going to test 4% again. Bang, right back to 430. And you're seeing a rotation here quickly among, REITs selling off, builders selling off. A lot of these, I call them, what they pose as tech companies, really, especially finance companies like Affirm and Upstart, right, that are dependent on funding their balance sheet continuously to do their business, start to get really hit here. And those are high beta names, and those tend to go up 3 or 4 beta from what's going on. So you're seeing that type of rotation again. And back to the Tesla, just to bring it full circle, I think that's really all it is. Google bounces off the lower alphabet, whatever you want to call it, right? Because it sold off so much. People want to keep money in the market. We've told people that's great. Mm-hmm. You can do that, but rotate, right? Rotate and find things. Energy, finding its footing, finally, Guy. I mean, so you're seeing a lot of that stuff happen. It's healthy to me in terms of what we're seeing.
But they're rotating, Dan, into a Microsoft, which now is trading about 31 times next year's numbers. Apple, which has obviously been selling off in a pretty precipitous fashion, on days that high valuation, high growth tech sells off, Apple catches a bid. Apple had been a source of funds. So this perceived flight to safety is taking the form of these names that are great companies, but expensive stocks.
Yeah, so it's interesting, talking about rotation too. If you just look at a Microsoft, which today, Thursday into the close, is trading at all-time highs, is making just a really counter move to what's going on in the market and some of the semi stocks and kind of the much-loved name like Tesla we just talked about. The stock has gone from 400 to 426 in about a week or so, and a lot of it has to do with the excitement, the continued excitement about their ability to kind of integrate this open AI, generative AI technology into other parts of the business. Today, it's JP Morgan talking about how they're going to use Copilot in security. So it's giving investors a confidence about the product roadmap. But Guy, I guess they're not particularly worried about valuation here. And I guess if you're going to have the strength of this secular trend, right, that's going to go for years, you know what I mean, then you don't care about paying 31 times because it'll essentially grow into that. And I guess the last point I'll just make is like this stock over the last, call it, 5 months or so has had consolidation periods. It's given you the opportunity to kind of buy the stock before it ramps. I'm just not sure at this stage of the game with the NASDAQ 100 trading, 7.5% higher on the year as we get into the end of this quarter, we might see some rebalancing. This is the largest market cap company in the world. Maybe that's kind of getting ahead of that if you think about the ETFs that it plays in. Like, I just don't know. I just think that the story is well known, and until analysts can start materially ratcheting up earnings, given where the stocks are trading on the valuation levels, it just doesn't make a lot of sense to me piling into them right here, right now.
Well, I would say that Microsoft and Alphabet, Google, whatever, I'm always going to call it Google,
yeah, you will.
Are certainly they're not cheap, but they're also much more defensive, if that makes sense in nature, relative to some of the other higher growth like an Nvidia, right? Because you feel comfort. Yes, is 31 times expensive? Yes. Is it expensive on historical? Yes. But they feel like at least there's a much more stable business there, meaning that while it's not growing as quickly as like an Nvidia, you have something else to fall back on. I think in terms of people who've been underweight that, overweight Nvidia, listen, you automatically become overweight Nvidia when you just don't sell anything. It's a fund manager. And the other ones are underperforming. So you find yourself, all right, let me take some off, right? Nvidia here, let me throw. So that's all they're doing.
But there is some dispersion. I mean, like when you just mentioned Alphabet, I mean, that company's supposed to grow earnings, 15% and sales similar. It's trading about 21 times.
Reasonable
so we just
valuation.
talked about Microsoft at 31 times.
Yeah.
The difference here is that investors don't believe or they don't have the confidence in basically the product roadmap that Google or Alphabet has laid out. So they're basically voting with their wallets right now that they expect poor execution going forward, and they expect Microsoft to continue to execute. To me, Guy, though, that sets up, I think, for a good like kind of reversion trade in a way. It could set up as a really good pairs trade, especially if Microsoft gets a little overdone to the upside and then Google continues to languish, because at some point there will be some sort of valuation sort of compression.
So Google is trading about 143. So if you go back November, like many stocks, we've talked about this, the high in the prior all-time high was made in November of 2021, roughly $150 or so. And then we had this high a couple weeks ago, probably in January, of about the same thing, about $150 give or take. So you had these double tops in place we've talked about. And then you've had this sell-off. So how do you trade Google in terms of what Dan just said? Well, you could do one of two things. You could buy it here and say, we're going to break through those double tops and be off to the races. Or you could say, you know what? I'm going to wait for validation that we're through those double tops. So maybe buy the breakout, because I think, quite frankly, around 144 or so, you got a 50-50 shot at this point. So it seems somewhat counterintuitive, but I'd rather buy Google through this prior all-time high of 153 and change than to buy it here at 144.
And all fair, and that's just kind of stylistically, like if you think about, and Danny, maybe you can opine on this as you think about portfolio construction, kind of dipping your toe in the water here because of that valuation discrepancy and knowing how these stocks can get going once an investor group starts to focus on execution and say to themselves, okay, Google has literally been tripping over themselves for the last kind of 14 or 15 months. Sooner or later, they're going to get something together. And when you think about the fact that they have 9 properties that have over 1 billion users, 3 or 4 that have 2 to 3 billion, if they're able to kind of get some of these generative AI products across those platforms, then they're likely to see the excitement from investors that Microsoft has seen over the last year or change. And that's why, to me, I'd much rather be buying Google here with sentiment really poor and execution equally poor than kind of piling into Microsoft, where sooner or later, valuation will become a headwind to the story.
Great balance sheet, low expectations, anniversarying some of their issues, as you just mentioned before. I think that's right. And I think you could, like I just said, you can feel safe owning names, even though, listen, it's not that expensive. Or if they can get the growth back on track or show that, certainly give them an excuse to buy the stock, right?
It's interesting. About a month or so ago, Apollo made a call about the broader market. They said we're in a bigger bubble than the 2000 dot-com bubble. Earlier this week, they basically reiterated that for a number of different reasons.
Torsten Slok?
Excuse me?
Yeah, Torsten Slok. Torsten.
I like the way you said that.
I think didn't he come on Fast Money, though? We were talking a little bit about this, Torsten. I mean,
Maybe.
Kaiser Soze.
I just know. I mean, the way you said it's like a Kaiser Soze.
That's what he sounds like. Anyway, it's a compliment to Torsten.
But it's interesting, to hear it from Guy Adami. Okay, it's like saying Barracuda on a crowded beach. Nobody sort of bats an eye. But when you hear from Apollo, it's like, oh, you say shark and you have a panic on the 4th of July. Now, I'm not trying to get people to panic, but they're basically iterating or reiterating some of the things that we've been saying for a while, that you say what you want, and bubbles can last for a long time. But, they look at the numbers, just the metrics in terms of price to earnings and a couple other things, and they say, guess what? It is different this time. It's actually worse in terms of valuation. And now it doesn't appear that way right now. I mean, everything seems clear sailing. But, man, below the surface, Dan, when people like this make comments, you got to listen.
Yeah, and listen, again, it's not like they're talking their book. These aren't like VCs who are littered, you know what I mean? The landscape with early Gen AI investments and the like. And, I'll just say this, there was an article in The Information earlier in the week talking about how some of these big hyperscalers, Google Cloud, Amazon's AWS, Microsoft has a big cloud operation, how they're kind of tamping down expectations internally. If you think about who the beneficiaries of Gen AI applications, right? All these large language models that have been built and how they're going to work their way into different industries and different businesses using them. They're going to do them through these big hyperscalers, through these big public clouds, right? And they're internally, this was, again, The Information, we'll put it in the show notes, saying that some of their sales folks and some of their people who forecast this stuff, they're trying to lower expectations a little bit because a lot of that kind of rush into these products has happened. And then if you can't commercialize these things, if you can't get revenue based on these, if it's expensive, the compute and the like here, then you're likely to kind of tamp it down. So I guess my point is when you think about bubbles, it's not too different. No one was particularly sober in 99 or early 2000 about what could happen. And I think we've been through these cycles before and we've seen it. So when you use the term bubble, a lot of folks will point back to 25 years ago and like none of these companies made any money. They were pre-revenue. They weren't pre-revenue. Okay, that's a fact. So I guess my point is at least we know how these things come undone. They can come undone from very profitable companies who might have misallocated resources in the near term, and then you have this sort of snowball effect if everyone pulls back just a little bit. And again, I think these are very crowded trades, Danny. That's the other point.
That's what I was about to say. You just kind of hit it right on the head. Is that it's a secular trade. These are old traditional companies that they're always innovating, coming with something new. If that starts to back up, so to speak, it all backs up quickly, and then it becomes okay. Secular trade, I get it. Great macro. What's the micro? It becomes cyclical. That's what happened in 99, 2000. But let me just be very clear. The bulls are still in control of this market.
Yes.
Okay. And good for them. And I think one of the differences, obviously 99, 2000, is obviously the access to real-time information that you have now. And I also think that some of these products are much more tangible to the consumer, that they can actually, ChatGPT, I know what this can do. Oh, that makes sense. Data centers, that makes sense. No one's taking the time to add up all the market caps of the companies to realize that the math probably doesn't work. Unlike the fiber, I'll go back to again, fiber optic. That was kind of foreign to people in terms of, you're digging fiber underground and then eventually we're going to use that all for the data and web hosting and all that stuff. They didn't want to take the time to figure out that it wrapped around the earth 100 times. My point is that
you just
there
said
were
it best. People who said it, but they were literally treated like lepers.
Exactly.
You're the guy, you know what I mean? Crowd yelling, Barracuda at the beach on July 4th, and who cares?
Right. So someone said it. I can't remember. I saw it on a show the other day. It's all about the narrative, right?
That's right.
The narrative changing. If the narrative shifts at all, it's going to be very damaging. But when that happens,
but Guy, the best example is EVs. 2 years ago, EVs were going to take over the entire automotive business. And so every piece of shit EV company that was listed was making new highs every day. And Elon was a god or a golden god. So my point is think about how that narrative has shifted in just the last 3 years. From November 21, when it was a $1 trillion market cap company, it's now down 60%. It's down 45% from its 52-week highs. The reason why we harp on this is because we've seen this before. And sometimes this is just a little bit of the canary in the coal mine when you have a much loved name like that.
Another great point. I say this all the time. When you have a company that's going to grow into its expectations, like Tesla, and it did, right? Earnings. Once you get to that level, then what? And so that was a secular trade in EV, and it kind of came into its own. And now it's cycling. It's cyclical. And so now it's
well, you've
more
been
fundamental.
saying that it's cyclical because they are an industrial company,
right?
And they are subject to rates, and they're subject to consumers, and they're subject to inflation, and they're subject to tariffs, and they're subject to all of that sort of stuff. And so to me, again, like why we talk about this sort of stuff is because we've seen it again and again. We're going to be a little bit early on some of this stuff, but I guarantee you, most of the other folks that you're talking about, just look at the way the bulls on Twitter and Tesla are eating themselves alive. They're at war. They're not even focused on the TLSQ crowd anymore. You know why? Because they've been right on the fundamentals, guy.
Fisker, getting back to this thing, this was a $30 stock, I think, in February of 2021. And I'm not saying trade this. I'm not saying anything because it's a less than $100 million company now. For perspective, it's now a 15-cent stock. Yeah. Rivian, if you remember when Rivian came out, everybody was Google over Rivian, game changer, blah, blah, blah. In terms of price to sales, it made 0 cents. We tried to point that out. Nobody wanted to hear it. And as we're sitting here today, it's a $10.50 stock. So there are a lot of things to be, in terms of what Dan just said. When you realize the fundamentals and you take away sort of the euphoria around these stories, that's when things start to come back down to earth. So that's what I'm looking at.
All right,
there.
I'd rather buy Rivian at $10.50 with an enterprise value of $6 billion
and cash on about the whole thing.
So when I think about it, they have $9.4 billion in cash. They're expected to lose that over the next 2 or 3 years. Okay, we know that they're going to continue to raise money. Ford's in there, Amazon's in there. They have some
Middle
backers.
East money in there.
Yeah. So my point is, I'd rather buy Rivian at $11 than I would at $162 for Tesla, because I think of Rivian not too different than Tesla post-IPO in 2011 or so. And it did succeed, but just none of us thought it should be $500 billion, let alone $1 trillion 3 years ago.
Yeah, but I would say that the TAM seems much more defined in EVs than it did. So when you're comparing the two at the time, I think where we are, what inning we're in of EVs, EVs are going to be around. Like, let's not, but the growth rate is dramatically slowing. So that would be the only pushback I would give you on comparing the two, I'm saying.
Tesla's deliveries could go X growth this year. Think about that.
Yeah.
So for instance,
they could go to 1.6, 1.7.
So last year they did 1.85 million or something like that. That's consensus right now for this year, and that's come down pretty hard. And that's one of the reasons why the stock has been selling off over the last week. A bunch of analysts have come from like 485 deliveries this quarter, which gets you to that if you're saying sequential growth of whatever, single digits, that sort of thing, that would get you to that positive number. Now they've come down to Q1 to about 420, and most of them will get there. If you do that 4 times, you get to a negative number.
I mentioned that the bond market was showing me the way. Hopefully it's been showing you the way as well. There are a couple other things, Danny, that I believe are showing us the way.
Bring it.
Gold market.
Yes.
Hanging in there.
Yep.
Bond yields go up, bond yields go down, dollar goes up, dollar goes down. Gold hangs in there like a champ. So as we're sitting here, gold's effectively at an all-time high. I think it goes higher from here. But we're finally starting to see, Danny Moses, and again, we talk about this all the time. We've established that gold's at an all-time high. The stock market is effectively at an all-time high. And some of these mining stocks are 50% lower than their all-time high. So something doesn't compute. Now, I get it to a certain extent, but there's going to be a massive catch-up trade in these, I believe. And I think it's going to be squarely on some of these miners through the GDX, which we've talked about. You want to play individual stocks. I know you talk about PHYS, but is the gold market showing us the way?
Oh, it's as stable as it's been on a relative basis in quite some time. We talked about last week, I did the podcast with Vinny and Porter, What Are We Doing?, that people should be nervous and excited at the same time that everything was going up.
Right.
Bitcoin, gold, stocks, bonds, because yields were going down. Bonds, I'm like, something that doesn't work. Like, that can't go on for a long period of time because they all should be a little bit counter to each other. But yeah, gold is here, and what you've been pointing out is just the lack of physical gold that's out there, and how you want to own, obviously, physical gold if you can, and that's why I like PHYS and Sprott, because they actually have the physical gold, unlike GLD. GLD is more of a proxy, but if you want to trade it, that's fine because you're trading it for the direction it's going. But I think it's here to stay. I think the miners you really have to be careful and look at in terms of, but again, some miners are better than others. I think you're going to continue to see consolidation within the miners potentially. I think you'll see that a lot of M&A there, and I know we're going to shift to energy here in a minute.
Yeah, but you know what's interesting, Guy? You and I were talking about this yesterday. I think in the last month or so, gold has rallied 10%. Okay, so this is like a $14 trillion global market cap. Is that correct?
Mm-hmm.
And then I was looking at like Bitcoin, nerd gold, right? And so that thing has been up 50% in the same time period. So think about that. That has a $1.4 trillion market cap. So it's gained $600-700 billion in the last month alone.
Yep.
Okay, but if you look at gold, it's also gained about 1.4 trillion. So it's actually, from market cap terms, it's gained more. And I think it's interesting to see that there might be some sort of narrowing at some point a little bit, because I think one of the pillars of the bull case now is that this is a store of value in property terms, not currency terms, right? And so Michael Saylor was talking about that on CNBC earlier in the week, and he's got a whole host of reasons to kind of get people convinced why they should be treating this like a
whole billions
asset.
of convert reasons.
No doubt about it.
Yeah.
But, listen, Guy and I have talked to Michael over the years, and is kind of out there as he might sound, is some of the financial transactions they're doing with MicroStrategy. I can't speak to any of it. I just can't. But he does make sense, and he does put his money where his mouth is.
No question about that.
So I just think at some point, and he's made the case that if people really do understand this or think about it in the terms of like buying a townhouse in London or New York City or whatever, and you would not spend that thing, you know what I mean, that scarce asset, because there's going to be others who are going to want to buy it at some other point. To me, I mean, it does make the sense for Bitcoin narrowing the gap. I'm not a buyer of Bitcoin right here because it does seem like a frenzy, but I buy that case for Bitcoin.
No, that's been the bull case. And Brian Kelly's talked about this for years in terms of Bitcoin or crypto's overall market cap compared to gold. And if it were just to garner a third or half of that, you can do the math and understand where Bitcoin would be trading. I get it. I don't adhere to it, but I understand it. But quickly, in our world, there are a number of different legends. Stan Druckenmiller happens to be one of them. On February 19th, he got out of some tech companies and he bought Barrick Gold and he bought Newmont Mining. Not huge positions, but he is clearly bullish of the metal, and I think he's going to start to layer into a larger position in these mining stocks. So again, you don't have to listen to Danny Moses. You don't have to listen to Guy Adami. But when people like that make a move like that, I think you have to sort of take notice. The other thing, Danny, that I do believe is showing us the way, to go back to Peter Frampton, is the energy market, which has had this stealth rally not only in crude oil, but in gasoline as well, that nobody's paying attention to it. I will tell you what is paying attention are the refiners out there, specifically a Valero, which seemingly goes up every day. So thoughts on the energy trade, which I know you also like.
I think that the supply-demand is now more in balance. I think that people saw numbers, less supply out there, an excuse to buy the commodity and then in turn buy these energy stocks. I think they're just cheap. They screen cheap relative to everything else in the market. We've talked about ExxonMobil. We've talked about Chevron. You can buy them. You can buy their targets, Pioneer and Hess. You can do whatever you want. You can buy Valeros of the world, right? This sector has been underowned, right? Underappreciated, and in fact, underinvested because there was no one was giving them money. So now you have these companies with these great balance sheets. And so this is about a stable, far from, if oil goes to obviously $50, $45, obviously these stocks are going to get wrecked. But we said at the beginning of the year, if you're a soft landing person, then you have to be looking at energy, because the only thing that I think would take energy lower is a full-out recession, a really slowdown of the global economy. China, obviously, we've gotten through. They're going to start comping, I think, probably easier stuff down the line here. It's slowed down dramatically and less growth. It doesn't take a lot for China, if it upticks at all, I'm not saying it is, to get oil going again. So I like it. I like it relative to oil prices, and I like this relative to their, historical valuations.
I don't think it should be mandated that we as citizens watch the State of the Union or the State of the States for individual states, but I happen to watch the State of the Union, and one of the things I was looking for, Dan, was, is Biden going to say anything about big energy and oil? And quite frankly, didn't really come up, which I took to be, you know what, maybe they're sort of backing off. So whatever bullseye had been on the back of these companies, and there's a huge bullseye, I think to a certain extent that might be taken off without the market really not sniffing it out yet. So the fact that it wasn't mentioned, they weren't vilified during the State of the Union, I think speaks volumes. And maybe that's another reason these things are starting to get off the mat.
Well, you made this point on numerous occasions over the last few years. It's really just not too different than we talked about supply chain issues. This is a matter of national security. So when you think of, I don't even have all the stats, I know you guys do, about the amount of drilling that's happened here is very different than when he was on the campaign trail back in 2010 20 or so. So like, listen, it shows me that they're a bit pragmatic. They get it. You know what I mean? And, we spent a lot of time talking about the release of the, the SBR, the Strategic Reserve in early 2022, as the war in Ukraine was happening. So, again, I mean, to me, I think all of those things, it'd be very hard in a second administration for them to turn tide on that, because I don't think a lot of the geopolitical stuff changes that much or so. I don't think a lot of the inflationary stuff like you think is going to change that much. So the idea that we continue to drill here, you know what I mean? And also the backdrop is that this administration, one of their biggest legislative wins of that first administration was a lot of the climate stuff they did. Now you could say it's kind of hypocritical. No, not if you're kind of like you're kind of putting it up against some of the other priorities, both domestic and geopolitical and security.
The irony here is that the higher that oil goes and stays higher, it self-fulfills two things. One is that the energy stocks need to be bought, and two, that inflation is potentially more embedded. And so you actually have a self-fulfilling rotation that will occur because you will come out of the interest rate sensitive stuff, right, by nature, and you could potentially go to energy. So something to keep an eye on kind of as a proxy for that as well.
Not to get all wonky, but copper, the commodity, is actually breaking out of a pretty significant downtrend. I believe over the next couple of weeks, to you folks that watch the network, I think you're going to hear a lot more people talking about the potential for, as Dennis Gartman used to say, Dr. Copper to rear its ugly head, and what story, if anything, that's telling. And again, there's certain things that are commodities, and I look at a commodity as something with an end use. Clearly, crude oil has an end use, and obviously copper does as well. Gold, to me, it gets labeled commodity, Danny. I never viewed it that way. It's a much different asset, whatever you want to call it. It tells a much different story. And I'll tell you this as well, and you mentioned it with Vinny and Porter. When everything's going higher, but when gold starts going higher in a meaningful way, that's a wake-up call for a lot of central banks around the world. And I've said this on this show. I'll reiterate for our new listeners. In 2022, global central banks bought approximately 1,141 tons of gold, over $70 billion. It was a record in terms of tons and in terms of dollars. They basically did the same thing in 2023, and they're on par this year to do similar, understanding we're only in March. China's been buying gold as well, by the way, for you playing our home game. So when central banks, and I've said this, and I'm curious as to your thoughts, I've said they're hedging their own ineptitude. But I'm telling you, if gold starts to have a move that I think it's going to have, then I think risk assets are in for a huge wake-up call.
Well, the weird thing is gold historically worked during inflation. It hasn't worked during inflation, right, for years, right? So it was weird the other day when CPI print was hotter than expected. It's like gold down on higher CPI. It's just so funny that, the narrative has shifted so much. But here it is holding, and it's bigger than that, to your point, Guy. It is same way that Bitcoin.
I believe that it is.
The same way that Bitcoin, and we talked about this, was in strong hands. It got through a lot of crises. If that's a lot of things it got through, and then it became self-fulfilling. Gold, unlike Bitcoin, I think has uses. Now Bitcoin hopefully will prove to have more uses over time, but it becomes self-fulfilling. There's just not enough gold out there, and the Bitcoiners will tell you, the bulls on Bitcoin will tell you, guess what? The halving thing's going to happen. There's not enough of that either, and it's in strong hands. So when these ETFs that came on board, and I think we're probably over 10 billion at this point, can potentially move Bitcoin that much, and/or Michael Saylor wants to keep taking out converts and keep going by tens of thousands of Bitcoins. Great. But if it goes the other way, in Bitcoin, unlike gold,
almost wiped him out.
Unlike gold, I'm saying he's a levered play, MicroStrategies. Yeah. Why is it trade? Why is there such a divergence between the price of Bitcoin and the value of MicroStrategy? Because it's a levered. It's like a 3x ETF, if you want to call that on Bitcoin to a degree, right? So you want to play a bigger. You can own that stock, but
So our podcast, obviously, if you're listening to this, it's either Friday or Saturday. We tape these on Thursdays. I bring that up because it's important. Last Friday, something happened, Dan, that you don't see all that often. And we saw it in a number of stocks, but we obviously saw this in Nvidia, which obviously surpassed the $2 trillion market cap. And that stock on Friday of last week made an all-time high of $974 before having a huge reversal lower. So from peak to trough, that company lost approximately $230 or $240 billion. And the point that I've been making, everybody seems to think that's normal. There are only maybe 50 to 60 companies on the planet that have a market cap of $230 to $250 billion. And we lost that in the course of a few hours last Friday. I mentioned it. Listen, we could wake up next week and it's trading north of 1,000 and everything is fine. But to dismiss that as normal, I think, again, people just don't want to acknowledge some things that we haven't seen in quite some time.
Right. So next week, this is an event that a lot of folks are kind of focused on. It's their basically their user conference. It's GTC, Nvidia. They're going to host an investor update also with an analyst Q&A, and it's a big user conference. And Jensen Huang is doing like a 2-hour keynote. I think that's on Monday, and I think the investor update is on the 19th on Tuesday. I'm looking at the options market right here. So as we're Thursday into the close, the stock is trading Nvidia at $880. The at-the-money straddle that expires next week, so a week from this Friday, okay, as you're listening to this, is basically implying about a 10% move. So a 10% move in either direction is exactly what you talked about from last Friday, okay, $230 billion in market cap. That is what is that's what is at stake next week as it relates to Nvidia. And I guess the one thing I would just say is if there is the slightest bit of disappointment, this is a company that reported on February 21st, it guided up 10% or so, got the stock up 10% to new all-time highs. If there's the slightest bit of disappointment, you will have another reversal. The more times that you have the stock make a high and then reverse lower, it just gets into weaker hands. People get more and more nervous, and that's why you're seeing these options premiums where the skew, where people are willing to pay more for the same percent out of the money call as they would be for protection on a stock that's up 70-some% or something on the year, hundreds of percent over the last year or so. That's telling you that investor sentiment is a bit out of whack. So next week, big event, whether you like it or not, whether you're sick of us talking about it or not too different than the way we've been talking about Tesla. Sooner or later, this is going to happen. And back to Mel's comment on the pod from last week, well, what if I listened to you and I was out of it here and there? Listen, we've been on both sides of the thing. Yeah, I've tried to trade it. I also, on January 5th, went on CNBC and said this thing's about to explode when the stock is trading at $490 and detailed a way to play it through calls. So, again, I've been negative because of the sentiment bubble, not because of the secular story, Danny.
How could they say something that creates, more excitement? And but what I'm saying by that is now the stock could be at 700 by the time that happens, or it could be at 1,050. Yeah. It's all the narrative. Again, the stock was at 600, 700, 800, 900,000. To me, it's pretty much all the same. Do you want to have exposure? What's the directional play? How's the momentum going? But who is the incremental buyer other than the forced chase? The same way that Tesla has sold off, it fed on itself because people, portfolio managers had to get out of it. If they were overweight or they realized they had to start to get out. Same way that these things go up, it self-fulfills that you have to own it. What is the moment? So better put it this way. Oh, stock's down $60. Well, look at that. I'm going to buy it here. Why? What is the fundamental valuation you're using to step back in? That's the problem with trying to time momentum is always hard. I'm not saying to go short this stock at all. What I'm saying is, what's your buy point signal? Wait, if it starts to sell off. And
the buy point
has to be much lower.
It's lower.
It has to be much lower. And that's the scary part about momentum. And that's what we try to help people just be aware of that because, it's down. Why is it down? Why was it up so much? Why don't people question the volatility to the upside versus a
the point
because they're getting shit rich long it.
Well,
that's right.
It's interesting that you say that, and the point you've made, Danny, a number of times is sometimes the better short is when something is down a
Correct.
lot. You've said that as well, and it's interesting, Dan, what you just said. And why does it matter on the upside? I recently saw something about Apple being at a couple of standard deviations lower than a moving average in an oversold condition, and what a great sign that was, and people getting apoplectic. But when things are 3, 4, 10 standard deviations to the upside away, nobody seems to care because that's normal. That speaks to Danny's point about, when things are going well, Dan, you said it as well, nobody cares because everybody's getting rich. But when things are going poorly, they're the first to point out these are the reasons why we should be buying things. All right, so we told you Nvidia is one of the big stories next week, Danny, but I don't want to bury the lead. We have a 2-day Fed meeting starting on Tuesday, culminating on Wednesday. I think actually I shouldn't say that. Potentially as big a deal as Nvidia.
A daily double, so to speak.
Daily double.
Yeah, as we get into horse season.
As we do. Almost time for the spa as we get into the summer, but please.
By the way, the Belmont is being run at the spa this year because of construction of Belmont.
I saw that.
That's pretty exciting. The spa is Saratoga for those people who don't know. Big 2 days next week.
Yes.
To Dan's point, you're seeing option market pricing in huge moves. It's probably not just because of the Nvidia Analyst Day. It's probably also because of the Fed. Fed expectations to keep higher for longer. You tell me in the last few days, barring a huge market sell-off, the tone going into that meeting is going to be, don't look at May. You can start to look at June, and it's coming in accordingly right now. And the scary thing is, not scary, but you're seeing softness. You know, I think we
Yeah.
talked prior to the show about some of these smaller banks seeing delinquencies and so forth like that. But retail sales, people thought were going to bounce back in February. They were actually worse than expected. So people are spending more on their credit card. People are a little bit extended. Again, not making it bearish or bullish call, but if you have a situation where inflation gets a little bit higher than
Which
expected
it
and the
is.
economy is a little slower than expected, are the Fed's hands tied? And if that's the case, that's an excuse to take money off the table and rotate into safer names. I think we've seen bits and starts with that in the last 6 weeks. And I think if this does go next week and they are a little higher for longer, I think we'll see more of
Next week, we're going to drill down a little bit more. You know, the employment data to me is concerning. We'll talk about that. We saw the unemployment rate go from 3.7 to 3.9. I don't want to make a big deal out of that. But if you look, Dan, at some of the revisions, the last 10 out of the 12 months revised lower in a meaningful way, I still think, again, you know, if inflation's sticky and if the unemployment rate starts going higher, to Danny's point, the Fed's hands are tied to a certain degree, so we'll see. But when we come back, the great Caleb Silver will be joining us. Look forward to that conversation. He always brings a few nuggets, so stick around. Welcome back to the On the Tape podcast. We are joined by Caleb Silver, the host of Investopedia Express with Caleb Silver, and their editor-in-chief. How are you, Caleb?
So good. So good
It's
to be
great.
back here.
We're excited to have you. There's so much to talk about. I mean, you come on Fast Money, I think, quarterly, and I look forward to the times you're on toward the end of the show, but we always learn something from you. So let's talk right now in terms of the anxiety index, because I know I'm anxious all the time, but, I mean, you do surveys and this stuff. Speak to me about where the anxiety is and what people are sort of thinking about.
Yeah, so the Investopedia Anxiety Index really is an index that measures the volume of traffic going to fear-based terms. And those fear-based terms will be across the markets, across the macroeconomy, and across personal finances. And when you look at anxiety in the markets, it's really low right now. I mean, really low as the VIX. It's asleep, basically. So market near or at all-time highs, people are chilling, but it's been a slow grind higher, so nobody's that anxious, although there are a lot of questions about what's the all-time high, what usually happens when we hit all-time highs. We get a lot of those types of questions. When you look at the macro picture, that's also relatively chill in terms of the macro economy, and the data from the government will show you that it's relatively chill. But when you look at personal finances, that part of the anxiety index is spiking. These aren't necessarily the same people, but a lot of searches for hardship loans, a lot of searches for can I tap my 401k, a lot of searches for what's the best personal loan for me right now. I think people are worried, not by and large, but a certain segment of the population, fixed income, lower income folks are worried because they're having a tough time making ends meet.
You know, the point we made earlier in the show was we're seeing this, and I hate the term, but for lack of a better one, this bifurcation in the form of a lot of different things, but most recently, Dollar Tree, they reported earlier this week on one side of the spectrum. They said some pretty disastrous things. It turns out it wasn't necessarily Dollar Tree specific because we heard some similar stuff from Dollar Gen the next day. On the flip side of that coin is the Williams-Sonoma, which is obviously an entirely different consumer that's making new all-time highs. So to your point, for a lot of people, and we seemingly don't want to acknowledge or talk about it, despite the fact that the stock market's at an all-time high, and despite the fact that pundits will come on and say how great the economy is, a lot of people are hurting right now, and it's manifesting itself in your surveys.
Yeah, tale of two cities, tale of two countries, however you want to look at it, that's what we're starting to see. And a lot of it has to do with the fact that, yes, we know inflation has subsided. Doesn't mean prices are coming down. This is not deflation, especially when you look at things like health insurance, car insurance, food away from home. But it's that interest inflation that a lot of people who are making the median income or even higher, even 150 grand a year, are having a hard time with. Those APRs on credit cards, right? The mortgage payments, if they're just got into a mortgage, anything that is costing, that has interest tied to it, is costing more, and people are having a tough time making ends meet.
It's funny, you know, Caleb, from a fast money perspective guy, myself, we've had trouble with that whole notion of the long and variable lags of monetary policy, right? And that's something that we've heard a lot as the Fed kind of prepared, I think, market participants and consumers and the like to get in this mindset that rates were going to go higher. That started in late 2021. It persisted throughout 2022, and we really haven't seen the slowdown in economic growth. We haven't seen the slowdown in consumer spending, which is why I do think this data is really important at this stage of the game. We have markets at all-time highs. We just saw unemployment tick up off of 50-year lows. We've seen inflation really stop going down. I know on a cumulative basis, every increase that we see in any period is was higher, right? But there was a couple things I think is interesting that stuck out. So this is Thursday afternoon into the close. Lennar is down, 4.5%, 5%. This is a stock, a home builder that was trading at all-time highs, and investors are not particularly happy with their gross margins, right? So the profit that they're making on their sales. And this is on a day where all of a sudden rates off of a hotter than expected PPI are up 10 basis points. We're back on the 10-year at 4.3%. But it was a headline that really caught my eye from Lennar: mortgage customers coming in with more credit card debt. So again, think about this: long and variable lags, all of this stuff. No matter who you are as a consumer in the U.S. over the last few years, you might have had some student debt canceled. You had interest rates go to zero. You had PPP. There was a whole host of things that were keeping you afloat. It seems like sooner or later, we're going to have to pay the piper on this. And is this what some of the data is starting to suggest here?
Yeah, absolutely. They say the Fed raises rates until something breaks. Well, a couple of years ago, it was the banks. But we really haven't seen the consumer break yet. Delinquencies are up a little bit. They're still at 2019 levels. But we haven't seen them break yet. Retail spending goes up because we can't get out of the habit of spending, and we can't get away from higher prices. And especially the lower income earning households just have to pay these prices every single month. They're the ones that are getting stretched. That's why you're seeing that from Lennar. That's why you're seeing it from a lot of companies that usually do well when you see economic conditions tighten a little bit. Not really happening right now. This is real split happening right now between folks that can afford to live that life that they've been living and folks that are just having a hard time making ends meet. And the wealth effect from the stock market being at all-time highs, usually you feel that a little bit more throughout the economy. I don't think we're feeling it as much now, even though 60% of U.S. adults own stocks.
It's interesting. Meme stocks were a thing, and I know on your surveys they reared their head many, many times. And what's fascinating to me, Caleb, is Nvidia in a lot of ways has become a bit of a $2 trillion company that's become a bit of a meme stock. So what are you seeing on that front in terms of some of the searches and in terms of some of the interest from people?
Yeah, they're very interested in Nvidia. They're very interested in all AI-related stocks. And no matter what, even with a drop in some of those stocks lately after blistering all-time highs, they're still interested in those. They're still interested in AI-related ETFs. People are wondering where the top is, but trying to get in on it. But there's also some people on the other side looking at the inverse of that and seeing if maybe this bubble is gonna pop. How do we benefit from that? So you see promiscuity on the edges. You see a lot of people also, when you look at what retail investors are buying, they're buying Nvidia. That's their top favorite stock right now. They're buying Alphabet, AMD. They're buying Supermicro Computer because that's been hot as can be. But they're still buying Tesla, which is way, way off its highs. It's in a bear market and has been for quite a while. Retail investors, especially the believers, won't stop buying it, even though it's the most shorted stock in the market.
What do you attribute that to? Because you just said it. Tesla made its all-time high, I want to say 3.5 years or so ago. The stock is now around 60% off its all-time high. So clearly, if it was named anything but Tesla and the mystique of their CEO, we probably wouldn't be having this conversation. So is it simply that, this belief that he will figure this out and guide people through? Because, as you said, the duration with which the stock is sold off and the level that it's at would suggest something entirely different.
Yeah, it's the true believers, and they believe he'll pull the rabbit out of the hat, and they've been right almost every time, although it takes a while. This has been a pretty long bear market for Tesla stock, and there's now a lot of competitors. The business itself is challenged in a number of ways. They had to do steep discounts to sell cars, a lot of cars last year, and the goals are pretty lofty for this year. So it's the true believers that are going to buy that stock no matter what, and they'll do anything that Elon is attached to. That said, the rest of the investment community has pretty much turned their back on it right now. So it's a little bit of just chasing the fandom that you see with Elon Musk. And I think it's a lot of people saying, hey, I've watched this stock go down 60% before, and I've seen what's happened after that.
Yeah, what's interesting, though, is like when you think about to Guy's point, in November of 2020, it was $150, and the S&P announced that it was going into the S&P 500, and the stock immediately ramped $100, like literally in a straight line, if you recall that. The S&P was just below 3,600 at the time. So here we are. We have an S&P above 5,000, and we have this stock down 60% from its all-time highs in late 2021. And I wonder, a lot of the survey work that you do and a lot of the kind of just data that you see, like, do investors care about relative performance? Like, this is obviously the meme stock to end all meme stocks, but it's breaking. It feels like GameStop like 2 years ago, but people don't want to believe it right now. On a relative basis, the S&P that's rallied 40% in that time period versus this stock that's basically flat. That's an absolute disaster if you're an institutional investor.
Yeah, I think most retail investors, and I'm not talking about traders, they get very accustomed to the home cooking. They get very comfortable with the stocks that they've been buying for the last 10 years. And those top 10 stocks, and we all know which ones they are, most of them are underperforming the S&P 500 by a broad margin right now. So they stick with them kind of through thick and thin. They're curious, and they may go out on the edge for a super microcomputer or a company, even an Abercrombie & Fitch, which has had an incredible run lately for a bunch of different reasons. They may do that, but in general, they stick with the top stocks in the S&P 500. They're index investors who are individual equity curious, but pretty much stick with the same home cooking month after month after month.
Search terms is a fascinating thing because depending on what's going on in the world, obviously, I mean, we've seen some really interesting ones over the years, things you would never have thought of. But speak to me about some of the search terms that have made their way into your surveys.
Yeah, well, we've been getting some interesting ones lately, and some of it's very company specific. A lot of people have been looking into Boeing, given its problems lately, but Bitcoin obviously is having yet another moment. Some of that is the spot Bitcoin ETFs. Some of it is the halving. So we're looking at a lot of searches for what is Bitcoin halving? What does it mean? What does it do to the price? What's a Satoshi? Who is Satoshi, right? How do I buy a spot Bitcoin ETF? How do I cash out of my Bitcoin or my Ether? So a lot of people trying to take some profits here. A lot of search around that. Again, I mentioned the personal finance stuff, and I don't want to give it short shrift because I do think it's important. With a lot of people looking for best personal loan, can I take a loan to pay off my IRS tax bill? I saw that spiking in the past few days. Tapping 401ks, that's been on people's minds too. And we know that Vanguard said that more and more people were looking for ways or actually tapping their 401ks for loans. Some of that is people need the money. Some of that is there are some changes in the Secure Act that allow you to take some money out without penalty as long as you meet some certain criteria there. So there's a little bit of that going on. But again, it's that seesaw of the promiscuity. Can I take advantage of this ongoing bull market and these stocks at all-time highs? Or should I be protecting myself, and how do I protect myself and my family?
Let's talk about Bitcoin for a second, because in the last, let's call it 6 years or so, there's been this this retail frenzies, and we've seen them kind of make them into altcoins, into NFTs, you know what I mean? But it's always like Bitcoin and ETH are the two main players in the space here. At least my perception right now, with the spot Bitcoin ETF being approved and the expectation that there will be one for ETH, I think a lot of folks who wanted exposure to this space, who didn't love all the riskiness of having to get a crypto wallet and doing a lot of that sort of stuff, especially if you think about what happened with FTX and Binance and the like, all of a sudden, you in your Fidelity IRA can get exposure to this. You know what I mean? In a way, I'm curious, have you seen a lot of differentiation in some of the search topics about people interested in doing it with their well-known broker that they've been with for a long time, the idea of putting it into a tax-advantaged account versus all the difficulty and the risk and all the kind of craziness that has been in and around the crypto space over the last 5 or 6 years or so?
Yeah, and if you just look at the inflows into the spot Bitcoin ETFs over the last, 2 to 3 months, that's been the most aggressive inflows into any new type of ETF product ever. But it's still a very small percentage of the market. That said, the interest is high. So people are looking for, the best with the best expense ratios, best performing right now. People are wondering how they actually work. Like, what is that creation redemption aspect of a Bitcoin ETF, which is fascinating once you get into it. But I was talking to Bitwise the other day, and they said, this is all retail right now for the most part. We haven't even opened this to institutions. They're not even involved here. So there's a lot of enthusiasm in terms of what this might mean for price. And then the halving event that's supposed to be coming up in April sometime, when it becomes twice as hard to mine a Bitcoin, which is usually good for price because supply gets tighter. People are really into that right now. So it's not that same frenzy we saw in 2021 or we saw in 2018, or even back in 2016. We've been covering Bitcoin since 2014. This is a little bit different and a little bit more orderly, but you can't ignore the fact that these ETFs have taken in so much money.
How long have you been doing this for now?
I've been the editor-in-chief at Investopedia for over 8 years.
It's a long time. And my sense is, and if I'm wrong, please tell me, everybody else seems to, you've gotten to a point now where you probably have friendly wagers internally about, okay, what do you think is going to be the most searched term for our next survey? And sometimes you're right, sometimes you're wrong. Sometimes things come from out of nowhere, right? Just exogenous events that you never saw coming. But if you had a guess, do you have any thoughts given, all the data and what you're seeing on the ground? What do you think you're looking for over the next survey or so in terms of search terms or search things?
Yeah, well, we're in field right now with our latest survey, and I'll have the results out next week. And they're always fascinating because it is having your finger on the pulse of what is on people's minds. And I think we're going to see a lot about the Fed, even though the Fed's not going to do anything. Just the words matter, right? And the words that the Fed says matter. So anytime there's a Fed meeting and we get near a Fed meeting, we see obviously spikes for things that are related to interest rates, but we also see a lot of mortgage activity. We also see a lot of people deciding if, when and where to refinance, when to sell, when to buy. But we also see people making choices outside of Investopedia. We look across the portfolio within Dotdash Meredith. We're a part of that big publisher. We have travel and leisure. We have food and wine. We have Better Homes and Gardens.
People, baby.
We have people. People love people. So I like to look at if people aren't able to buy homes right now, and we still have that housing affordability and very high mortgage rates, what are they doing to their homes? They're doing a lot of like fixture stuff, a lot of garden stuff, a lot of mudroom stuff. They're making improvements here and there in the absence of being able to sell or being able to go out and buy. So I think it's definitely going to be interest rate related unless we have some black swan event. When we had the bank issues a couple of years ago, a year and a half ago now, there was a lot of search around
bank runs. I'm
bank
sure
runs,
came up.
Exactly.
Right.
How much of my money is protected? I even saw some questions in the last couple of weeks because of what was going on with New York Community Bank about the same thing. People fear that their own bank may be vulnerable right now and their money in the bank may be vulnerable. I don't think that'll be a top term, but AI has been very popular and it's going to continue to be popular right now. Obviously, people are interested in the TikTok situation, but from a broad perspective, it's going to be around interest rates and the moves they can make with their money.
Quick follow-up on that. So, for example, if FDIC insurance is something that you see searched, what have you, and this is a tough question to answer, so I apologize, have you been able to glean what potentially are leading indicators in terms of the things searched? Like you go back, that Rolodex in your mind, you remember like 7 years ago, this was searched, and subsequently, this is what happened. Am I making sense with that question?
Yeah, absolutely. We can look at historical patterns and see what happens when these types of things happen. So bank runs is a good example of that. Obviously, the financial crisis, we have data going all the way back to when we were founded in 1999. So we have all of that data, and we always look at what people are looking for. So we know that when we get to these interest rate decisions, it'll be questions around that. It'll be questions about how interest rates affect different parts of people's financial ecosystem down the stream. So we know that's going to happen. But there's also the seasonality things. And the seasonality can't be ignored because we have a lot of people who come visit our site, about 15 million a month.
It's amazing.
Some of them are students, right? And you can tell when it's Econ 101 and classes in session, and you can tell when people are looking up SWOT analysis. They're probably in some strategy class or in their McKinsey consulting orientation. We know when those things are happening, but we also know that tax season brings out a lot of search volume around things that you would not think would be related to that. What's taxable, what isn't, obviously, but also different ways to use their investment portfolio in a tax advantage way, or how to work with your advisor on that. A lot of tax questions right now, a lot of tax questions around crypto right now too.
All right, listen, Caleb, if you listen to the On the Tape podcast, which I think I know you do, you hear Guy preface any conversation about domestic politics like this. I could give two shits about politics.
Bore me.
They bore me. That's what he usually says. But we are forced to kind of talk about it because policy, is the thing that affects the economy. It affects monetary policy. It affects how, you know this. We don't need to tell you this. So at what point have you guys gone back and looked at past election cycles, particularly presidential election cycles? When do investors start getting focused on the election? Obviously, the headlines this week is the two candidates are set, right? We know these two candidates both have been president before, which is kind of an interesting sort of setup. And I think Guy and I kind of both feel like policy is not likely to change too much. If you think about, other than some of the social issues, we haven't seen a huge differential on the economic stuff between Trump and Biden for the most part. What are you guys starting to see right now? And is it really maybe a little too early, or when do you expect it to kind of kick into gear?
Not at all. When we've been doing the sentiment survey now for the past 3 or 4 years, but starting about 6 months ago, the U.S. presidential election became the number one concern on our readers' minds. And it's not the who's going to win, it's the chaos that's going to surround the next, whatever that is, 8 months. And they're worried about that I don't know if they're worried about it as it relates to their portfolio as much as they're just worried about it. And I don't think it's a him versus him type of thing. I think it's the event itself that scares people. It's an event that could have profound implications if history is any guide. But also, we do see a lot of search because the two candidates are set. Which president sat atop the largest spike in inflation? Right? They're looking for a reason, a causation between inflation and who's ever sitting in the Oval Office. We know there really isn't that much of a causation, and there isn't much the president can do once there is inflation, or they can talk about shrinkflation all they want. But they do try to find causation between elected officials and what could be happening to their portfolio.
So we're a little over 2 years into Russia-Ukraine. We obviously have a war in the Middle East, tensions in the South China Sea. Our relationship with the Chinese is probably the worst it's been in 50 or so years. North Korea is always a wild card out there. Geopolitical risks. What do you see on that front?
Yeah, we see those on that list. We list those as choices for our readers in the sentiment survey, and they're down that list like 5, 6, 7, 8. But up there still is inflation, right? Interest rates, the Fed's handling of monetary policy. These are top concerns with our investors. But number one for the past, I would say, 6 months has been the presidential election. Again, not the who's going to win, but what is that going to mean?
What are the ramifications to their pocketbooks, basically? So let me ask you this question, because, we sort of dance around it a little bit, but a lot of people are hurting out there without question. And, we hear what a great economy it is or so. Do people look for the relationship between the economy and the stock market? Because I would submit with each passing day, that relationship gets wider and wider.
Yeah, wider and wider. They are not one and the same. We know that. Sometimes they show up at the same barbecue, but they are not one and the same. So people are wondering, if the economy is so good, why do I feel so bad? That's
right.
The real feel of the economy that doesn't get captured in government data. Yeah, you see it in the Gallup polls, you see it in consumer sentiment. I don't know how much I actually believe that or who they're actually talking to, but I don't think people feel, by and large, great about the economy. And they always say the economy is the number one issue when I go to the polls. That's the easy thing to say. It's actually not that. If you actually look at the polls, it's not the reason, though. It's the easy thing to say when you're walking out of the election, the voting booth, for people to say that was the top thing on my mind. And it's not like the president, whoever it's going to be, is going to make a very big difference there unless they slash taxes across the boards or raise them. So it's always on their mind, but it's not. It's the correlation between, if the economy is so good and the stock market so good, why do I feel so bad? One quick thing on that. We were talking about top search terms. Well, last year in 2023, our top search term was the American dream.
Really?
And it wasn't like, how do I get the American dream? I think it's the fact that the American dream, quote unquote, is out of reach for so many people. And a lot of that was driven by high mortgage rates and housing unaffordability and the ability to be able to live a reasonable life, raise a family in this country. We actually put a number on it. We totaled it up based on what you might spend over a lifetime and having a family, 2 kids, sending to school for just a couple of years, having 6 used cars over your lifetime, owning a home, putting away $500,000 to $750,000 for retirement, $3.4 million. That's what you kind of need. That's kind of the number. Now, it's different for you. It's different for me. It's different for your listeners. But if you take the median income over that lifetime of working, you only get to about $2.3 million. So there's a huge gap there, right? And people just don't feel like they're going to be able to get there. So the American dream is very prevalent in people's minds, not about how I'm going to get there, but why can't I get there?
How attainable it is in this environment, given what's going on with everything.
I did all the things I was supposed to do. I went to college. It cost a lot of money. I got a job.
I did everything right. I played by the rules. And it's interesting. I think that's why so many, again, without getting political, I think that's why so many people are so disappointed, and there's such angst and it's sometimes anger out there with a lot of the people, because they feel like they've been playing by the rules, yet everything you just talked about is, without question, unattainable for them.
Yep. And it shows up in so many things, not just in, how do I attain it, but how come I can't attain it, right? I thought I was supposed to save money. I thought I was supposed to invest money. We paid $250,000 for me to get my education. Now what?
All right, let's talk about the business that we've chosen. Guy, you know what I'm doing there, right?
Yeah, it's a little Godfather thing.
Yeah, a little Godfather. All right, so it's interesting. You just went through, and if you go to Investopedia, you see all sorts of resources on there. You can get real-time information about what's going on in the economy, in the market. There's a whole host of just really, well-placed things, from financial literacy to, like personal finance and obviously investing, okay? But here's the thing. This is just kind of, you just spent a lot of time talking about retail is interested in AI, right? One of the first things that got, I think, a lot of retail people focused on AI is ChatGPT, right? So these large language models. Guy and I spent a little time with the CEO, founder of Perplexity, and he's a guy who's in a really smart team. They've built this, what they call an answer engine. It's not a large language model. It's a wrapper for large language models, and it's really kind of trying to compete with why people would go to a Google and search for something, right? So I just put this question into Perplexity. Why is the stock market down today? In about 2 seconds, it gave me an answer with a bunch of sources. Okay, it said the stock market is down today primarily due to a combination of factors, including surprise inflation data, significant sell-offs in major technology stocks like Nvidia and Tesla, and broader concerns over market valuations and economic indicators. Are we screwed here? Because that was pretty good in a sentence there, right? And it all happened like that. But I think about, listen, Guy and me, we might be screwed. An organization like yours, which is a destination for 15 million people a year. I mean, you guys are probably harnessing a lot of this different technology. You have the benefit of being a trusted news source, right? And partnering with the right thing. I'm just curious how you guys are thinking about this, because this has come on the scene in a very short period of time.
Yeah, that's a great question. And that's a pretty good answer.
It was a pretty good answer. Guy, we're out, buddy.
Yeah.
Right. Yeah.
I would, just on a side note, clearly I'm not using it. There's impossible for me to be less interested in that stuff, but please.
Okay, so the answer to that question, or the question itself, is a pretty general question. And there's a lot of answers to that question today. And even some of the big news organizations out there are actually using AI to write this, because this is not that original of a question or that original of an answer. And what's original, we can have a long conversation about that. But think about the way people use Investopedia or a site like ours. Most of the traffic, most people come to us through search, right? They search for, what do I do with $10,000? We talk about that in the sentiment survey. They search for 401k, Roth IRA, right? But all of that is intent-based. So everybody has an intention. Now, if you took all the questions that we get over the course of a day, you would find that a lot of them are surrounding the same thing. But behind the question, the original question, is an intention. So the question of Roth IRA or 401k or how do I invest $10,000, that is an intentional question. Somebody's about to put money to work. Now, the answer for you, Guy, is different for the answer for me, is different for the answer for your listeners, right? Whoever you are, that's a different answer. AI can help us get people down that path to the specific answer they need for themselves. So we may use it to say something like, oh, it sounds like you are looking to put money to work. Let's get a little bit more information, much like you might do with a financial planner. We're trying to help people get further down the journey because we know the top of the funnel is a very general question. How do I invest 10 grand? We could all ask that question. The answer is very different, so we want to make sure we're getting people down the path. That's how AI and large language models can help us, because we've seen the question before a lot, but we have answers for different people at different life stages. That's how we intend to use the technology, and I think it could be really powerful for us, and I think that's ultimately where you want to get to, because, again, there's the top, the top of the funnel, and then there's where you really want to go, and we want to help people get all the way down the path.
You've collectively built an amazing company. I mean that sincerely. Again, I mentioned earlier you come on with us quarterly on Fast Money, and I absolutely look forward to that, as Dan does as well. But looking forward, like, what are you excited about as you continue to evolve as a company?
Yeah, well, you know, we're going to be 25 this summer. So 25 years on the internet is like 250 real years. And it's incredible to be around. And I'm just blessed to be able to be the editor-in-chief. We have a great team. What am I looking forward to? Well, applying large language models and applying some of this technology to help answer questions as best we can. Because at the end of the day, we are in a digital world. We're in an AI world. We see what Google, Bing, and others are doing with their AI models on the search engine pages. They're answering the questions themselves. They want to be the answer. We think brand matters. We think real people, real editors with real expertise matter. So we're going to try to push that as far as we can. And we feel like we're going to be here another 25 years. But in terms of tools and stuff like that, one of the most popular pages on our site is our stock simulator. I'm telling you, tens of thousands of people come in there every month and start trading for the first time with fake money, right? It's a great way to learn. It looks just like all the
mechanics of trading.
The mechanics of trading. I want us to be able to simulate your entire financial life, much like you do if you actually sit with a financial planner or an advisor, the intake, the conversations, the follow-up, because it's complicated for everybody at every different life stage. And I think simulation, the ability to see things, what would happen if I went through this door and then I took that bridge?
Right.
That's super powerful. And I think that's the future for us and other educational brands like us that want to make sure we're a part of people's lives down the road.
Hey, listen, Guy, you heard it. Brand and expertise. So we're not done yet.
You're
buddy.
not done.
I mean, like maybe there's another leg for us here.
I hope so. It's interesting. You know, you can simulate a lot of things, and I'm with you, and you should absolutely do that. And one of the things that these machines can't simulate, though, is emotion. I mean, they can. So it's one thing in trading to have a simulator, but when you actually have real money involved, it creates a whole different set of circumstances around it. And that's something I don't think, unless there's some application out there that I don't know about.
Well, that's called the AGI, Guy. See, that's the thing here. So at some point, Skynet is going to be trading with this sort of emotion of a meme stock day trader. Yeah.
I don't know this.
All right, well, listen, I mean, you know, again, and Guy did say it. I know that you and Melissa have a lot of history, and it's always a lot of fun when you come on Fast Money, but we're really fortunate to be able to kind of, you know, take some time and go through a lot of these topics, because I know a lot of our listeners are really interested in this sort of stuff. They don't always know exactly where to find it, and the fact that you are the beneficiary of all of that search data because you are a trusted source, it means a lot for you, for us, that you come on and drop a little.
It's my
knowledge
pleasure.
for us.
Thank you.
Thanks a lot, Caleb.
Thanks,
Appreciate
Caleb.
it.
That was great.